Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Decision day for the ECB. The central bank is expected to cut rates again, but remain tight-lipped on future action. Commerzbank bolsters its defensive strategy as it gears up for a potential takeover approach by UniCredit. And the UK unveils its plans for implementing the latest global bank capital rules. We'll get the details from the BOE in the next few minutes.
In the meantime, a quick check on these markets here. Anna, we are seeing green on the screen and in a pretty big fashion, a rebound, if you will. Eurostoxx 50 futures higher by 1.4%. The FTSE 100 right on its tails, higher by 1% as well. We're talking about the central bank decisions, the Basel requirements as well, and how that shows up throughout the world, as you mentioned. We're going to keep an eye on that U.S. two-year yield. 365 is what we're going to call euro dollar at 110.20. The countdown to the opening trade starts right now.
Thursday the 12th, good morning. The number of the day is 25, it seems. It appears we're going to get 25 from the Federal Reserve after yesterday's inflation data. And the ECB looks like it's going to deliver its second cut of this cycle, another 25 basis point cut. But where does Christine Lagarde take us after that?
Yes, absolutely. I mean, it's all going to be a focus on where we go after today, really, isn't it? Will she be giving us comments that are based on the persistence of inflation, or will it be the growth story she focuses in on? I mean, I've been writing down talking points on the ECB. There's a shorter list than usual, don't you think, Kriti?
It feels kind of like a little bit of a no-brainer. You brought this chart around when it comes to the Bloomberg Economics. They've been analyzing a lot of the Fed speak as well, ECB speak as well. It's the most dovish, I think, in a very long time. No surprise.
Except that the ECB faces many challenges, you could argue. It does have a slowing economy, but it does have sticky inflation. Which one is it going to focus on? Where does the focus lie today? And what kind of a guidance, therefore, will Christine Lagarde give us? Yes, the introduction is a dovish one. Will the ultimate result be that dovish? Well, let's find out. Lizzie Burton is outside the ECB in Frankfurt for us. Lizzie, walk us through what we should be expecting.
Well, as you say, Guy, we've had the busy summer of data that Christine Lagarde told us they wanted to wait for. And you've got inflation receding at the headline and core levels, but not at the services level. Perhaps that's attributable to the Paris Olympics. You've also had this key measure of wage growth easing in the second quarter. That's encouraging. But you've also got growth concerns mounting. So it all points to a quarter-point cut today. That's fully priced in markets. And as you say, the focus therefore becomes, do they cut in October? That's the disparity between the market view and the economist's view. If you don't have that, economists reckon that you'll have quarter-point cuts every quarter until rates hit 2.5% this time next year. But that'll be the focus of the press conference. I do think Lagarde is going to stay tight-lipped, talking about data dependence, not pre-committing to a particular path for rates, not just because of the data, but also because of the divisions on the Governing Council, the divisions over the risk to the inflation outlook, and also where the neutral rate lies. There will be something else interesting today, and I know that Kriti likes to get into the plumbing. A red herring, a 60 basis point red herring. You'll have cuts as well to two of the other rates that apply to banks from the ECB. This is to get rid of the disparity that's a hangover from the negative rates era, but it's just to try to lubricate the system of the financial markets. It's not expected to have an immediate impact on the economy or markets. It's simply to ease the process of shrinking the balance sheet. So technically interesting, but the real focus on the path ahead.
All right, Bloomberg's Lizzie Burton outside of the ECB in Frankfurt. We thank you so much. You, of course, will be covering that decision live. And certainly that we're going to be watching as well, especially ahead of the CPI. And before we pivot to what's going on with the Federal Reserve, we should talk about as well, this is the first time that the ECB is going to have the Bank of Spain actually voting in the last couple of months. The Bank of France won't be. It's a rotating kind of Rolodex. But when it comes to actually the minutes that we're going to get out of the ECB and the transcript there, this might be a little bit different. But Lizzie was talking about the market kind of telegraphing what the ECB is going to do. The market doing a completely different thing when it comes to the CPI data.
The CPI data has taken us back towards 25 basis points from the Federal Reserve, but the market is still pricing in the next, we've got 3 meetings after that. It thinks that we're going to getting a 50 basis point cut, at least 2 of those out of the 3, which I think is really interesting. Yesterday's data a little firmer than anticipated. 25, therefore, feels like maybe it is the right call from the Fed. But the market is still really aggressive in terms of its pricing from there. once again, do we find ourselves in a situation where the market is over its skis in terms of what it anticipates from the Federal Reserve?
Yeah, absolutely. So we're back to sort of talking about the same thing we were talking about in January. You know, is the market expecting too many rate cuts from the Fed? But we're informed by a lot more data, of course. Yeah, so that core number coming in better than estimated, taking out the prospect of a 50 basis point cut, it would seem, in market expectations. But thinking about what comes after this, in the same way as the ECB, we're sort of looking ahead, aren't we? In the Fed's case, there is no October meeting. The next meeting comes in November. We'll have two bits of jobs data, two job reports, rather, non-farm payrolls reports, before we get there. Yeah. And it comes just after the elections. It does seem that there are some, there's some huge inputs, two jobs reports going into that decision, plus the politics.
You made a key point there, which is that 50 basis points is basically taken off the table off the CPI, but so was 25 for just a hot second. You can see that on the chart in front of you, which I thought was interesting. You had almost 50 and then actually no cuts at one point priced in. Of course, the market reverberated back to, I think now we're at somewhere like 26 basis points expected for that September cut. But the fact that you're seeing this volatility from 50 to 0 in the matter of 4 trading sessions, Guy, I think that's a pretty big deal.
It is. But again, we're really struggling to figure out where we should be focusing our attention and how we should be thinking about what we are going to get from central banks. We spent the whole last year being whipsawed by the bond market, which has been a terrible predictor of where rates are ultimately going to end up going. Beginning of this year, we were talking about 7 cuts. We then oscillated almost down to none. We're now back to a reasonably aggressive cutting cycle. It's really hard. And I think the data are the real challenge here. Where are you focusing? What are you looking at? The data are sending conflicting signals. You can understand why you're getting this volatility, but it doesn't look like it's going to end anytime soon.
And back to that age-old question, if you're waiting for the data, are you going to be behind the curve? And often when you're talking about labour markets, it doesn't take long for that conversation to start. No. And certainly we can pick up on that. Let's go to the regulatory side of things, because there is some sense of anticipation around what the UK is doing on implementation of Basel rules. We heard from the Fed earlier on this week, didn't we, Kriti, about what their plans are? And remember, this goes back to 2017, when, the GFC before that, but it goes back to 2017 when we got the Basel rules crafted. They were supposed to be implemented by 2022. That doesn't look to be the case, and we're waiting for details of how the UK is going to do it. We know that some details have come through. The PRA, the Prudential Regulatory Authority, has published its second policy statement. It probably has a lot of detail in there. We're looking to see whether we get some conformity between what the UK does, what US banks are doing, what European banks are doing. Are they all increasing capital requirements, 9, 10%, that kind of area? And over what time period? Because some of the things we've heard about aren't going to be fully implemented until 2030.
Absolutely. And I think this is a really fascinating one as well, because this is where it gets very tradable very quickly. When Switzerland, I think about a month ago, came out and said, well, they're actually not delaying those Basel requirements the way that the US and the UK was expected to, it actually hit UBS stock pretty substantially, despite the lobbying efforts you saw from the banking sector in this region. Guy, I'm curious if we continue to see some sort of market reaction in the UK.
Just trying to read the statement and try to understand exactly what is being said here. So in terms of, I'm going to park the headline number for a moment. In terms of what we can, in terms of what I'm getting, the PRA has decided to move the implementation date, reading an issue this morning, for Basel 3.1 standards by a further 6 months to January 2026, with a 4-year transitional period ending on the 31st of December 2029. So that is being pushed out. So the implementation of this is being pushed out, which is interesting because others have not done that. So you're getting a slightly elongated process coming out. In terms of the headline number, which I'm struggling to kind of get my arms around, based on the latest data from firms, the PRA estimates the Tier 1 capital requirements for all major UK firms will be virtually unchanged by today's package, with an aggregate increase of less than 1% from January 2030 when the transitional arrangement comes to an end. So I'm just trying to wonder, is that... So are we sticking to the original 10% or are we at 9%?
Yeah. Maybe we'll wait for the team to get their heads around the detail. There's a lot of pages, I imagine, on this report.
Anybody's watching, Sam Woods, you're watching, send me an email. That would be...
There's someone in this building who is making sense of it right now. I know that.
Do you? Because I'm clearly not.
Okay,
we'll try and figure out exactly what's happening with this. This is important stuff. This is important stuff, and it is fairly difficult to determine exactly at this point what we are looking at. Anyway, we're going to work our way through this process. What else have we got coming up on the show? Camille de Courcelles from BNP Paribas Markets 360 joining us on her expectations for the ECB. We'll talk about the data out of the States as well. We're going to have a market conversation with Sebastian Raedler, head of European Equity Strategy at Bank of America Global Research. He's going to join us circa 8 o'clock. Jennifer Barker, global head of Treasury Services and Depository Receipts at BNY, is here in London. And because she's here in London, she's going to come and join us as well, which is going to be absolutely fantastic.
Yeah, excellent. So we look forward to that conversation. Let me tell you a few of the data points and agenda items that might be on your radar today. We get an IEA oil report today, and this is going to be really interesting in the context of the drop in demand and the increased supply, the seemingly robust supply that we've seen, and what that did to oil prices up until very recently. Now we seem to be worried about the potential for a hurricane to cause trouble, and so oil prices are a little firmer. But we focus in on the IEA and its report. The ECB decision, we've talked about that, of course. In the US, we'll get PPI, initial jobless claims. That's at 1:30 p.m. And we'll get some earnings numbers as well coming through. Kroger, Adobe earnings in the mix. Yeah, the IEA oil report will be interesting.
And
absolutely, yeah.
I was going to say...
You're going to find it interesting. I'm going to find it interesting.
I am going to find it interesting only because we had that really good conversation with Max Layton yesterday, and he was talking a little bit about the oversupply stories, basically saying that the market is signaling to OPEC that we don't want to be touching that. But I think it's also important that we're putting this in the context of what's going on in the rate space. We have the data coming out of the States. We have the ECB, of course, today. How does that affect the idea of just how much oil positioning you want, something to keep an eye on?
I got an email from Alex Steele yesterday, 3:36 p.m., apparently in the afternoon. A contango backwardation. She's asking if I'm jealous and we should be talking about this morning. No.
We did it yesterday.
I know we did it yesterday.
That should be the response.
Yes, absolutely. Jealous. Maybe a little bit. Anyway, let's talk about what else we need to know this morning. Dealmakers in China are finding themselves at the crosshairs of authorities there. Bloomberg has learned that at least 3 top investment bankers from different securities firms have been detained since August. Some state-backed brokerages are said to have asked staff to hand in their passports and now seek permission for travel. Nippon Steel is mounting a last-ditch push to gather support for its $14 billion takeover of U.S. Steel, a deal which has been opposed by President Biden, Vice President Harris and ex-President Trump. U.S. regulators are still reviewing the deal. U.S. Steel has threatened to shutter plants and move its headquarters out of Pennsylvania if the acquisition collapses. And the CEO of Boeing, the new CEO of Boeing, is urging members of the company's largest union not to strike, warning that a work stoppage could harm the playmakers' turnaround efforts. The 33,000 members of the union are due to vote, I'm telling you, reading this morning an issue, on the company's proposal today. Basically, this time tomorrow, we could see them walking off the factory floor at Boeing, which is hugely problematic. Kelly Ortberg's come in to this business. He's trying to turn it around. He's based himself in Seattle. He's walking the floor. They've offered them 25% in terms of the increase. The union is looking for significantly more. The deal was originally done by the union and the company back Monday, but the feedback from members has been aggressively against the deal. And the expectation is that we could see a strike. He's walking the floor, and from our reporting, it sounds as if he's meeting with quite a lot of resistance, even if they're not formally on strike yet, and might not be, depending how this vote goes. He's meeting quite a lot of resistance, air horns being sounded, a lot of protest activity right in front of him. He only took the job in August, didn't he? Yeah. And this is going to affect a number of different factories in the region. So you could also see at Renton, the 737 line, which is so critical to this company's turnaround plan, going offline. That's going to affect airlines like Ryanair. I think it's got its AGM today. I could be wrong about that. But it's a huge issue for the airline sector, who desperately want these aircraft to be coming through and are being faced with the fact that they're not going to get many of the aircraft they originally anticipated. And this is going to make it even more difficult if we see a strike. Now, the expectation is the strike could be relatively short, but you don't know. Yeah.
But the interest-bearing part is, you said 25% over 4 years. If you compare some of the other labor kind of movements in the States, it's similar, but it's also substantially higher. I think the Teamsters Union, et cetera, and all the kind of issues that we had in the rail strikes, 19% over the span of 4 years. And now that number is just getting higher and higher.
OK, let's talk about what's coming up in the programme. We are going to continue to focus on the banking sector. We talked about Commerzbank quite a lot yesterday, but there are further legs to this story and more news to come on that front. Commerzbank reviews its defensive strategy as it watches out for a takeover approach by UniCredit. We'll be speaking exclusively with UniCredit CEO Andrea Orcel. That's at 9:30 a.m. UK time, speaking to Francine. That'll be right here on Bloomberg TV. Plus, Roche's disappointing study, why the latest findings on their obesity pill are causing concern for investors. Up next, though, decision day for the ECB. We'll discuss what to expect from the European Central Bank. If you have questions, you want us to put your questions to our guests, then please do send us a message. IB plus BBTV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
I think it's more noise than news in the fact that the core number was slightly higher than expected.
I think at the end of the day, it was a disappointing reading. We were expecting slightly lower print last month. And, you know, we've had 0.2 cores now for several months, so jumping back up to 0.3 is certainly disappointing.
I think the inflation today at the margin is tilting investors towards 25 basis points in September.
The Fed should be moving people's expectations back from these large rate cut discussions into a much more gradual, steady approach at getting back to neutral and really begin the debate over what is neutral.
Overall, it looks very well controlled to me. It looks like we're not seeing deflation, we're just seeing a gradual disinflation. The inflation is gradually coming out of the system.
Some of our guests over the last few hours reacting to the August CPI print out of the United States. This side of the pond, we've got the ECB firmly on deck today. The anticipation there that we are going to get 25 basis points as well. Joining us to discuss all of this, Camille de Courcelles, head of G10 rates strategy for Europe at BNP Paribas. 25 from the ECB today, then what?
That's indeed the question, because 25 is fairly expected, especially after the latest inflation reading and even some more hawkish members from the ECB which have been endorsing rate cuts today. But what comes next is the key question. Will we learn much from today?
Yep.
Probably not, because the ECB is probably going to remain squarely data dependent, weighing on the one hand risk to growth, which are to the downside, but on the other hand, Schnabel has recently reiterated the fact that domestic inflation is still very high, very elevated. It has barely budged since November of last year. So therefore, we still expect the ECB to remain very gradual in its approach, weighing the risk to growth and inflation to the other side.
The ECB had to come out of negative rates when it started its rate hiking cycle. So it kind of started from a lower base and therefore didn't get as high in terms of where it took rates. How much room to cut does it actually have? Where's the neutral rate? Where could ultimately we be going here? The expectation on the other side of the Atlantic is that we're going to see quite aggressive rate cuts from the Federal Reserve. Can the ECB in any shape or form match those kinds of expectations?
So we think that the neutral rate in the Eurozone is probably in a range between 1.5 and 2.5.
Right.
But near term, so for the next few years, it's probably to the higher end of that range. So we do think that 2.5 is probably neutral.
They've not got that much to go.
It's not that much to go compared to the Fed, for sure, which also reinforces the gradual approach that the ECB can tolerate to do.
Camille, walk us through then what is going on in Eurodollar and in cable. If you're starting to see, to your point, this weakness and this kind of almost catering to the growth issues in Europe, why are the currencies so high, and why are they not underperforming relative to the dollar?
So I think, you know, we have started from a very elevated rates in the US. We have very wide rates differential still. So in our view, that rates differential will still continue to compress. Indeed, the ECB is at 2.5%, probably is the terminal rate, but the Fed can do a lot more. And the question is more towards the asymmetry of risk to the downside. Are we really going to a soft landing, or are we going to go to a harder landing? And in that scenario, we could have a much sharper rally. So you could see over the next year a much further compression of rates differential, which should mean a weaker dollar.
How much of that is a function? So we're talking about the fundamentals here. Let's talk about the positioning as well, because the market is still positioned long dollar despite these rate cuts. I'm curious how much of the geopolitical risk is actually going to show up in some of these rate differentials. I'm talking about elections and of course, the United States, but also some of the political risk you see in the likes of France, for example.
Yes, correct. The market is still very long the dollar, and it's one of the key difference compared to what we normally see, especially, for example, before a recession. So if we were to go in a recession, you would normally expect the risk of sentiment to be bullish the dollar. But in this case, we think that's the opposite. It should be bearish the dollar, because the dollar has not been used as a funding currency, as is normally the case.
And sorry, carry on, Camille.
But when it comes to the election, it's true that that is probably the key risk to our views. If we were to have a Trump presidency, tariffs being introduced, this should be more bullish for the dollar. So compared to our forecast, it could mean, I would say, a 2% increase on the currency. But at the end of the day, it will really depend on the scale of tariffs that could be introduced.
So plenty of risk to watch early November, the election and a Fed meeting, all happening very, very close to each other. Can I ask you about gilt markets and what we're seeing there? We've got traders fully pricing in 2 quarter-point cuts from the Bank of England this year. We got some data yesterday on GDP that was a little underwhelming. But having said that, Bloomberg Economics saying this took away the risk that actually we might have overheated in the UK economy with the labour market as tight as it is. What are you now expecting on the Bank of England front?
So we still expect a cut per quarter as well on the BOE front. The latest data is a bit encouraging, but it's very volatile as well. So we would not expect them to go in September. So therefore, the next cut for the BOE will only be in November. But I would tend to say rates market in general will remain very dependent to the US economy, what we will see on the labor market, what the Fed will do ultimately.
We had a guest on earlier this week who was talking about the synchronized nature of the rate cutting cycle that we're seeing in developed markets. Now, obviously, we haven't seen it start in the US yet, and Japan is a huge outlier.
Absolutely.
But elsewhere, that does seem to be the narrative. Are there opportunities still within that space to play rates against each other because some are cutting ahead of others and that sort of dynamic?
Yes, for us, the highest conviction trade at the moment is still to be long US rates versus short or other rates, so like Euro rates or UK rates as well.
Is it logical for the market to position for more cuts than less cuts at this point in time?
So, indeed, when it comes to the Fed, we have looked at previous recessions. And what we see is that, which is quite intuitive, but it's very visible. You can see that the more restrictive the Fed was before the recession, the more it has to become accommodative during the recession.
Okay.
So lending below the neutral rate and at a greater, for a greater magnitude. So according to our analysis, it would suggest that given the degree of restriction in place, the Fed, again, if we were to head into a recession, would have to lend 220 bips below neutral rates. So therefore, I think the risk for the market...
What was that number?
220 basis points below neutral.
Right.
So let's assume that neutral is at, I don't know...
3.5?
3.5.
Yeah.
You could lend at 1.5. But in a recession, the neutral rate normally decline as well.
Okay.
So you could still see a much sharper rally if we were to head in that direction.
That's interesting. Camille de Courcelles, Head of G10 Rate Strategy for Europe at BNP Paribas. Thank you very much indeed. We've got that policy decision coming up. We'll cover the ECB in detail later on today. This is Bloomberg. 30 minutes to the opening trade here in Europe. We are basically having to price in the afternoon rally we saw yesterday over in the United States. US futures are positive, just only up by 0.2%. But as you can see, the Eurostoxx 50 CAC futures both positive this morning, giving us an indication that we are effectively playing catch up here in Europe this morning. Initially yesterday, the US session dipped, but then delivered quite a strong rally as we got the CPI data coming through. So that's the story in terms of the markets this morning. I think we're still trying to make head nor tail of what is happening, with the UK Basel announcement, Anna.
Yeah, absolutely. We've heard from the PRA, the Prudential Regulatory Authority here in the UK, that they are going to delay Basel 3.1, the implementation date, to January 1st, 2026. That's one of the headlines that, Guy, you picked out at the top of the hour when we got this report. But there are a lot of words in here. And so we need to get some analysis on what this means versus other jurisdictions, versus expectations of when these things would be implemented. Let's speak to Laura Noonan, our global banking and regulation reporter, who's on the road but available for thought this morning. Really good to have you with us, Laura. What stands out to you from this? What do we need to take away from this latest news this morning?
So, morning, Anna. Thank you for having me. So overall, I would say at a first glance, this looks like pretty good news for the UK banks. So the bottom line is that the PRA says they have made significant changes to their original proposals. They are now looking at capital requirements. The PRA says virtually unchanged by the time this is fully phased in 2030, they're talking about an increase in Tier 1 capital requirements of just 1% across the big banks. They said they've made changes in lots of areas where banks had concerns. Now, the only caveat I will make is the devil is in the detail here. The PRA has always been saying this is not a big deal for banks in the UK, and it's basically capital. It isn't going to be that bad for them, although their previous estimate was 3%. But banks say that there are some areas where this is quite penal. And so I would caveat that this may not be as great for the banks as it looks like at the first brush.
Laura, how does this line the UK up with everybody else, the United States, Europe, etc.?
So it now appears that the banks in the UK will have the most minor impact. So we're talking about 1%, as you'll see there on the screen, 9% for the US, 10% for the EU. It looks very good. The UK has looked very good on paper all along. The initial estimates back in 2022 were 6% for the UK, and still the UK banks complained. So on paper and across at a very broad brush, the UK looks very good. But could still be some areas where banks have concerns. So initially, banks were very concerned about SME lending, about infrastructure lending, about residential mortgages. The PRA says it has dealt with lots of those issues, but I think we'll find out later today if they've dealt with them to the bank's satisfaction.
Laura, so this kind of feels like a little bit of relief, at least on the surface level, that maybe some of the UK banks may face. I'm curious about pressure they may see from across the English Channel. If we're talking about the U.S. now delaying it, taking a bigger picture, the fact that Switzerland and the EU is moving forward with these 10% increases, does that just create more pressure from the banking industry onto regulators and authorities?
So I think that what the banking industry has been saying now for the last year or two really is that we're still fighting the last war, I think, in terms of bank capital. So the biggest problems, I think most financial stability experts would appreciate, the biggest problems in the system are now, they're not the banks, they're the non-banks. So I think we've had this pushback for quite some time. And these rules, as some of the audience will know, were agreed in 2017. That's forever ago. The world has changed since then. So I think the bank's main pushback has been, listen, you're looking in the wrong place. We're still fighting yesterday's war. And we need to, these are minor tinkering. In the US, it was initially quite dramatic. They've all rolled back. But even when you talk privately to some regulators, some supervisors, they'll say, you know what? These rules, which were introduced for a good reason, it was about banks not being able to game the system, not being able to use models to make their banks, to put their balance sheets look much better than they are. But they would say these rules are not as important now as when we came up with them. So they are being delayed, yes. They are being pushed out across major jurisdictions. Switzerland now stands out as an outlier. It's the only one implementing in full in 2025. The EU, what they've done is a partial thing. So they're basically doing a lot of them in 2025, but the most internationally relevant bits, the market bits, in 2026. They may kick that further. The US, who knows the timeline there. So I think it's definitely being pushed out, but it isn't the fight that it once was.
I mean, where does this leave the whole Basel process, Laura? You've nodded to this a little bit already. We're considerably watered down from 2022 expectations, I guess. Does this just tell us the further we get from the GFC, the more time passes, the less regulators will look to clamp down on banks and their balance sheets and what they do with them?
I think it's fair to say that memories are certainly short, and the further that the banking crisis is in the rearview mirror, the further people will, the less urgency there is around this. And what you'll notice is an increasing dialogue around growth. We need growth. We need to fund the green transition, and banks need to play a role in that. And there is an appreciation that if you heap on ever more rules on banks to deal with old problems, it's going to constrain their ability to lend and to deliver the funding that economies need for growth. And that's the point that banks have been making for the last 3 or 4 years. And they have, as you'll see from the watering down in various jurisdictions, they have had some success in making this point. And the UK was between a rock and a hard place, really, because it very much wanted to be faithful to the original international text. And it would probably argue that it is still faithful to that. However, they also have this new secondary objective around the competitiveness of the UK banks. So when you have the EU and the US both doing something which is less faithful to the original accord, and if the UK has to make its banks competitive, it's hard to be very, very tough on Basel and to be consistent with that competitiveness policy. That's another thing that the UK has to juggle now, which they did not have to juggle back when these rules were introduced in 2017.
Laura Noonan, Bloomberg's global banking and regulation reporter, making sense of some of the regulatory story that we are hearing around the world. Truly, we thank you so much for breaking that down for us. I want to stick with the banking sector and talk about a major potential deal in the works. Bloomberg has learned that Commerzbank is reviewing its defense strategy as it watches for a potential takeover approach from UniCredit, the German lender, taking the precautionary move to UniCredit's surprise disclosure of a 9% stake in Commerzbank. Let's get more from Bloomberg's EMEA Finance Managing Editor, Tom Metcalf, who I'm sure is at the edge of his seat, watching every detail, digesting this like a soap opera. Walk us through what's changed in the last 24 hours. We know Andrea Orcel has had his eye on Commerzbank for a while. Do we see a takeover?
Well, look, I think the sense out there is, that's something UniCredit are definitely open to exploring. I would probably describe their posture as wait and see at the moment. And what's interesting about the Commerzbank story is you get a little bit of sense of, what the other side of the party in this transaction is thinking. For sure, they were caught by surprise. And, what I'm hearing is generally, they're not delighted by this approach. Obviously, they'll engage with talks with UniCredit as they would with anyone who takes a 9% stake in your firm. But I think, the fact that they are, again, very standard procedure, taking on a defence, looking at the defence strategy suggests they're certainly not open arms, excited necessarily about this. So it'll be interesting to see what happens. I mean, this all came about yesterday morning, and I suspect it'll take a few days for the sides to be really clearly delineated.
How on earth did the German government get caught on the hop by this?
Well,
they sold them the stake.
Well, exactly, and this is the fascinating thing, because we were talking yesterday. I was like, well, that would seem to be they're quite happy about this. But now we're understanding that that's not the case. They were, in many ways, looking just for a very standard accelerated book build.
But Orcel told them that he had the other part of the stake.
Well, yeah, exactly. And whether, stuff got lost in communication or, they didn't quite see how things could play out.
Because UniCredit put in they didn't do this by talking to the government. They did talk to the government, but the actual action here, the detail in the story is fascinating. It was a fill or kill order that UniCredit put in to buy, this chunk of a rival European bank, and gave the German government no choice, essentially, at the end of the day, because they were just offering more than everybody else.
Yeah, exactly. That's my understanding is, reading the terms of the deal offer, they were like, no, UniCredit said, look, we are the biggest offer here, and the German government obviously looked at this, even if they weren't perhaps delighted by the prospect of who the buyer might be, they also have an obligation to extract the most value.
Was the German government, my understanding is the German government was aware that they also had an additional stake. This wasn't an initial foray, this was part of an additional build that Orcel was pursuing. So he went from 4.5 to 9.
Yeah, exactly. So, the German government haven't confirmed that, so it's possible,
right.
The people who really needed to know, for some reason, that message didn't come through, But no, certainly, the communication seemed to have been there, and that's why, like you scratching your heads, because if you were a German government, you don't want one single buyer. There's different ways you could structure this deal, there's different ways you could word it, for example. And
money
instead
talks, I guess.
Yeah, absolutely.
Is this a UniCredit-specific story in that, one, could Commerzbank then attract other suitors in this process, and two, is this the first kind of opening or of the floodgates when it comes to cross-border consolidation?
Well, my answer to both of them, I get very excited. The answer is yes. So, certainly that's one thing we're looking for. Who might be, prompted to go, wait a minute, if Commerzbank is supposedly in play, we want to be in on this. Now, obviously, UniCredit are in pole position. They've built up a 9% stake. Effectively, that's a block-in stake. So I'd be surprised if they do try and pursue a takeover, if anyone can really get in there in any meaningful way, though perhaps I suppose there's a white knight or something like that. And then to your second question, does this then unlock further M&A? I certainly think it does. I mean, it's intriguing whether it would be the full-blown cross-border. Obviously, UniCredit's Italian, Commerzbank's German, but UniCredit has a big German unit already, so in some ways you can almost characterise this as between German borders that move. But for me, that's what I'm most excited about. Does one of these kind of deals start to sort of unleash all sorts of other opportunities? Yeah,
you can imagine boards all over Europe saying, well, should we get interested in this, especially if it does throw up some difficulties in Germany, given that UniCredit already owns some of the banking space there. In the same week, we see that ABN the government in the Netherlands is selling down its stake in ABN. That's not, revelatory. We knew that they were doing that, but they sold another chunk, 1.2 billion euros overnight. They'd still own 40% of that business. And I know our reporting has talked about whether Deutsche Bank might be interested there. They do see... we've had Mario Draghi talking about competitiveness in Europe, and lots of people saying that part of that is banking union and all the things we've been waiting for a long time. You wonder if something is the tectonic plates of consolidation might be shifting.
Yeah, it feels like the most sort of febrile time at the moment, and it's those kind of government sell downs which is also creating opportunities, right? You've also got there's NatWest in the UK, right, where the government's doing something similar to the Dutch government. So, and that's really what sparked the Commerzbank chatter, was German government, biggest shareholder, going, no, we need to start selling down, and that does create opportunities. So, as ever, the roadblocks are huge. There's massive hurdles, but I totally agree. In all the boardrooms, people are going to be talking about this.
Talking of boardrooms, there's a visit by senior figures from the City of London today to Downing Street to talk about what could be coming up in the budget, we understand. Should the UK finance sector be preparing for significantly higher taxes? Is that the read of the room right now?
I think that's certainly what they're most worried about, and I think this meeting is broadly speaking about the Basel rules that have just been announced. At least that's the official thing. But I think if I was a banking CEO going in to meet Rachel Reeves or Keir Starmer, I would just be very focused on the sort of fiscal side of things.
I'm sure there will be. Tom Eckhoff, thank you very much indeed. A meeting designed for Basel, maybe for something else. You can catch Bloomberg's exclusive interview. Francine is going to be sitting down with UniCredit CEO Andrea Orcel, 9:30 a.m. UK time. It's on the pulse. You definitely want to tune in. I certainly will be. There's plenty of questions that I think we're looking for answers for here. What are we going to talk about next? Roche is called lower this morning on concerns over the potential side effects of an obesity drug that initially, when we first heard news about this drug in phase 1 trial, sent the stock skyrocketing. We may be about to see the equal and opposite reaction to that. We'll talk about it next with Sam Fazeli. This is Bloomberg.
Welcome back at 7:46 in London, so 14 minutes until the start of what looks to be shaping up to be a positive session for European stocks. Looking for some of that US handover, some of the moves in markets quite substantial to the upside, more than 2% on the Nasdaq yesterday. How will that feed across into the European session? We expect some gains. US futures flat to positive this morning as well. Markets Live executive editor Mark Cudmore joins us to talk about the markets in 3 minutes. And Mark, let's talk about what happened in markets as a result of the CPI. The core number came in above estimates, caused a bit of a wobble for a moment as people thought, are we going to get the rate cuts? And then people decided, well, yeah, we are. We're just not going to get 50, which maybe a minority of people have been expecting anyway. So are we unchanged as we were post-CPI?
I think there are two interesting things here. One is that while we generally expect 25 basis points, there's still a little bit of uncertainty. There shouldn't be at this stage. It should be very clear as 25 basis points. Now, I know I'm biased because I've felt that for a long while, but the data does not justify more. The reason we're not 100% sure is because the most important person in this decision, Chair Jerome Powell, is the one who seems most inclined by 50 basis points. That said, I'd be very, 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 very surprised if they do 50 basis points next week, and I think the assumption will be 25 basis points. The other big takeaway is it's made retail sales more important. People are realizing that maybe the disinflationary trend has run its course. What they're wondering now is if inflation does get a little bit more perky, is it because the economy really is doing fine and could continue motoring? Or are we at risk of a slight bit of a stagflationary scenario? So I think retail sales will be really, really important next week. And I think it'll see a larger than normal reaction in stock markets in which way it kind of beats or misses.
Yeah. Mark, so 25 is good for stocks. Is that my takeaway from yesterday? Because there has been this narrative emerging over the last few days that 25 would signal that the Fed is behind the curve, and that is bad news for stocks. So we're back to 25 being good for stocks, 25 signals a soft landing. Because if you just take the next decision in isolation, that appears to be the case. The problem with that is that the market is still pricing in very aggressive rate cuts, the bond market at least, from here.
I think we're slightly backfitting the narrative to fit here. Look, at the basic level, rate cuts help stocks. But it's why we get rate cuts. And I think what's happening now is that people kind of going, hey, there's no reason to panic yet. Now, we've changed that narrative a little bit on an inflation print, which isn't pro-economy, which is why I know you're asking the question. It's a little bit confusing. We seem to prefer 25 basis points that is more about inflation rather than the economy's holding up. But I think that the general idea that the economy is going off a cliff was overblown, was a bit overdone. And therefore, rates is upside. And I think equities have upside. They had upside regardless anyway, just because we had got too down the recession path.
Mark, how does this show up in the dollar? 30 seconds here.
I think the dollar is going to stay super volatile over the coming few weeks because of that overpricing of recession, because of that overpricing of rate cuts, but the fact that the US story is still kind of positive. I am in the minority, I think the minority, maybe I shouldn't be so confident that the US election will probably be negative for the dollar either way, and even more so particularly under a Trump presidency. There'll be a knee-jerk positive reaction, but that reaction will not sustain at all because I think the undermining of the Fed and the fiscal situation is more problematic.
Certainly something we'll keep an eye on. Bloomberg's Markets Live executive editor Mark Cudmore, we thank you so much. You get more analysis from him and the team. Just type in MLIV GO on your Bloomberg terminal. Let's go from the macro to the micro. Joe Easton standing by with our stocks to watch. Joe.
Morning, Kriti. So we've got our eye on Roche this morning after this stock saw heavy selling in the US in terms of its ADRs last night, dropping around 6% after they released some data for their obesity pill. Now, the disappointing results showed that actually the people taking this pill saw higher rates of nausea than expected, and that is going to potentially affect its chances of getting approval. So this was the CT9996 pill. Bloomberg Intelligence saying that the safety data overshadows the strong results. So it does actually help people lose weight, but those nausea effects are what are concerning. And BI adding that it also tends to increase people's heart rates as well, which they see as another risk to getting approval for this drug. So we actually saw gains in the main obesity drug makers, so Novo Nordisk, US stock, and also Eli Lilly in the US, both of those gains. So Novo in Denmark today could be one to watch alongside Roche, which does look like it's going to fall this morning. Then we got our eye on banks once again. Firstly, over in Amsterdam, the Dutch government offloading around $1.2 billion worth of shares in ABN Amro. Now, they've been reducing their stake in this company for about the past decade. They bought the big holding in it during the financial crisis, so it's another sell down for this company. Now, I haven't actually seen a pricing on this at the moment in terms of where they sold it, but it would potentially be a bit of downside for this company. But the big story in banking, of course, continues to be Commerzbank. Now, there's a great note out today from JP Morgan. JP Morgan upgrades Commerzbank to overweight, and they write in a note that they think that UCG is attempting an outright purchase of Commerzbank, and therefore they recommend buying shares of the company. And they also say that they think this is going to be the start of a cycle in banking M&A in Europe. So they also actually upgrade ABN Amro, they go neutral on that one, and also upgrade BAMI over in Italy as well. Two stocks they like as also potential targets. There's the move in Commerzbank, up around 17% yesterday. So banking M&A stays on the agenda, particularly with those JP Morgan comments. Keep an eye on those stocks this morning.
Thank you very much, Joe. Our equities reporter, Joe Easton, with the latest on some of those stocks in focus. This banking story does feel as if it's something that might run. I mean, yesterday it was interesting that we saw Commerzbank, yes, up 17%, as Joe was saying. ABN was also up by 1.8%. There was a sense that some of these banks that have been talked about as targets might, finally we might get some news there. But you do have to wonder, to your point earlier, which other banks are going to be tempted to get involved here? We haven't heard much from France.
There's also another interesting angle here as well, is that the government, and you were bringing this up, a number of governments around Europe still hold stakes in banks, right? So if you're the market, do you conclude that those stakes are overhangs that ultimately will have to be offloaded to the market and therefore is depressing effects on the stock? Does this case change the narrative around that in as much as you've seen Orchel come in and pay a premium to that? So can we start revaluing and how we think about those overhangs on some of those key
does it depend how willing those governments are to sell them?
Precisely.
And that will depend on the buyer, perhaps.
But isn't this just a case of really good timing here in terms of negative timing for the German government where they're kind of having a bit of a cash crunch, but good timing for Andrea Orchel in that he's found kind of their weak spot almost, that they need that cash infusion? Can you make that argument about other banks or other governments that are looking?
Governments generally want money, right? So the Greeks. So he's done a similar thing in Greece as well. Are there other opportunities around Europe where these holdings are still existing?
Yeah. Well, the Dutch one is the example that we were talking about just this morning. Yeah.
The other piece of this, and we talked about this yesterday, was the impact on the buybacks and dividends, because that has been a outperformance for European banks and a reason to actually hop into European financials in the face of an easing cycle. The idea here that they're still returning those shareholders record amounts, by the way, even by a bigger margin than what some of the states, banks over in the states are offering. This could potentially hit that. This could potentially redeploy some of that capital to M&A if we see that cross-border consolidation actually come to fruition?
Stunning that European banks still trade on less than 1 as price to book. We've never really recovered.
No, this is all post-GFC still, isn't it? You know, we're still dealing with the Basel rules, the rate at which we implement those, the government stake in European banks. This is all a hangover from the financial crisis. And I don't know, as time goes on, we forget more, perhaps.
But it's also interesting as much as you come back to what is happening here in the UK. The UK is looking to tax the City of London quite aggressively, potentially, as part of the revenue-raising exercise that Reason maybe needs to go through. It all kind of fits together. Anyway, we'll talk about this. We'll see what impact we are going to get. Keep an eye on Roche. Keep an eye on the banks this morning. We will watch the European Open. That is coming up next. It is time, almost, for the opening trade. This is Bloomberg. Few minutes to go until the opening trade. Let me tell you, because this board is not going to tell you that what we saw yesterday was a rally in the afternoon stateside, which basically means that we're going to be seeing futures in Europe pick up, catch up to what we saw stateside yesterday post the CPI number, Kriti.
Yeah, I think that's exactly what you're already seeing here. An almost 2% rally that you see in the NASDAQ on yesterday's trade. It's kind of showing up here as well. And I think what's really interesting is that it's an almost 1.2% rally in Eurostoxx 50 futures. You look regionally, you look at the breakdown in terms of French futures, in terms of German futures. It is the same story. Slight underperformance in the DAX in the moment when we're talking about the futures picture. But Anna, over even in the States, you are still seeing green on the screen, marginal green on the screen, but green on the screen nonetheless.
Right, yes. So the futures picture, yes, marginally positive over in the United States. Let's dive into some of the stock specifics. Joe was taking us through some of these a moment ago, and I'll give you a bit more of the detail perhaps. So Roche certainly will be in focus. Will we see investors trading out of Roche and into Novo? Yesterday, in the United States, we saw the ADRs of Roche under pressure, and the Novo ADRs were gaining as a result of this news that there have been some negative side effects attached to the really closely watched experimental obesity pill that Roche is trying to bring to market. Some of those nausea, vomiting and the like that Joe was discussing. So might we see some trade between the two as a result? ABN Amro and Commerzbank in focus for really fascinating reasons. ABN Amro is being sold down. The government stake in that bank is being sold down, and so we've seen that overnight. That's taking a step forward. They brought that shareholding down from 49 to 40% or so. And we've got Commerzbank in focus for another day, of course, looking to get further details on what exactly UniCredit intends here. We'll be tuning in for that all-shell conversation later, Guy.
Absolutely. Looking forward to that. The opening trade is almost upon us. We are anticipating a strong start here in Europe this Thursday morning. It is ECB day. We're going to focus on that a little bit later on, but let's focus on the equity story first of all. You are seeing some upside in the FTSE 100. We're up by 0.2%, 0.3%. But keep an eye on what is happening with iron ore, the miners. It's interesting talking about what is happening in that space, potentially further legs to the downside in some of the commodity spaces. So factor that into your FTSE thinking. The stock 600 is out of the gate. We're up by 0.5%. The FTSE 100 is now up over 1%. This is the catch-up trade to what we saw in the United States yesterday. The CAC Iran's out of the gate up by 1.1%. So again, some decent gains. Waiting as ever for the DAX to open. We'll see how positively it opens. We're keeping a firm eye there on what is happening with the banking story. Kriti, what are we seeing below the surface?
Well, let's start with that banking story, because right out of the gates, you are seeing some green on the screen when it comes to the banking sector, and that's going to be a crucial one. You're seeing that sector higher by 1.3%. That's an important one. Remember, the entire market is rallying. So how much of that is a response to the kind of light rules that we got on the capital requirements remains to be seen. But, of course, you do have a major outperformance in the tech sector as well. That's going to be, Anna, a little bit of a read-through from yesterday.
Yes, just diving into the banking sector. We don't have an opening price on Commerzbank for another day, so that seems interesting and one to continue watching. The gains across the banking sector do seem to be not substantial, but pretty broad-based so far. And we do see a bit of upside for the French banks as well as the UK banks. So it's not as if the UK banks are standing out because of what we've heard around Basel today. The best performing sector is basic resources. And that's interesting because we've had some really interesting mood music around, well, more than mood music, around China. We just see the line crossing the Bloomberg terminal that China's CSI 300 index has closed at its lowest level since early 2019. Chinese growth concerns typically weigh on commodities, but that hasn't stopped a bit of a rebound at the margin in some of the commodity plays over the last 24 hours. Certainly through the Asia session, we saw some strength there, and perhaps that's filtering through into the European equity session as well, Guy.
It's interesting. Jake Lloyd-Smith on the M Live talking about another leg lower. Iron ore is due a fresh leg lower, so you wonder whether that's going to feature in their thinking around those basic resources. The movers are interesting. What you're basically seeing today is maybe some rotation out of Roche into Novo. Novo is a pretty strong performer. Keep an eye on that. As you can see, Roche is at the bottom of the screen. I need my eyesight checked.
Yep,
I can just about see that. There you go. So you've got that to factor into your thinking. So maybe some rotation within that. So Novo is rising on the back of that. The chips are looking fairly solid this morning. But as you say, the miners are also popping higher. So maybe a bit of rotation within the healthcare sector.
I think the breadth is important to notice here, because in our 50 underperformers, or bottom 50 performers, the underperformers, you still have 3 out of those 5 in the green here, Anna. So it really speaks to the idea that this is a fairly broad rally. The question is, does it stick into the close?
Yeah, absolutely. Let us talk about what is happening with European stocks then this morning. We caught up yesterday with Emmanuel Cao from Barclays, who identified Europe's exposure to the global economy as a key impediment to its recovery. We'll listen to what he had to say and then continue the conversation about the global growth story and how that plays out for Europe.
We're also struggling to see a strong case for Europe to outperform. I think the main story is about, look, Europe is a player on the cycle. If you believe in a soft landing, if you think the recovery is going to carry on into next year, we're going to have some mid-cycle rebound in growth next year because central banks are delivering some support to the economy. Europe is a very cheap option. Europe is a big player on China, so it's very hard to see European economy, European sentiment decoupling from China. And you have this ongoing threat, which is coming from the US with the election.
OK, a lot of thoughts there from Emmanuel Cao, head of European equity strategy at Barclays. Let's get another perspective. Sebastian Raedler, head of European equity strategy at Bank of America Global Research. Sebastian, nice to see you as ever. Now, last time we talked to you, I think we talked to you about how you were negative on European equities, seeing some downside for the Stoxx 600. And I think that's still the case. But I think you've turned a bit more positive on this China angle. Can you give us a bit more detail on what you're thinking there?
So you already have you effectively have a very bifurcated narrative. On the one hand, global growth, very strong, risk premium globally extremely tight, therefore equity markets close to all-time highs. And then you've got the China plays like luxury mining, they're already beaten up. But crucially for us, we would take the other side of the narrative because we think there's still more pressure in Europe and the US from all this monetary tightening that you've done. And it's feed through into a weakening labour market. And, of course, there's intense focus on the labour market. China is the only major region where you haven't tightened policy, where you've actually eased policy at the margin. So we expect the credit cycle to improve there. And that is a key driver of the economy. So we think there's still downside risk to the US, but relative to very bearish sentiment right now, upside risk to China.
OK, that's interesting. And what's the timing like on that China call? Because you could have perhaps, we've heard people talk positively about how cheap things are in China or how policy will come to the rescue, and then you hear sort of drip-by-drip policy initiatives from China, and it doesn't seem to be enough. And we just covered that line about the weakness in Chinese stocks as a result. What makes you think that the timing is now?
So effectively, you had very weak second quarter growth in China, weighing to some degree on the global angle. You had an extremely low PMI print in July, which already started to reverse in August. So we think you've seen the trough in the second quarter in terms of GDP, in terms of the PMI in July, and effectively you get a more, as I said, a more supportive credit contribution into the macro cycle. And then people are very worried about the housing market and the property sector, but of course that is very levered into the credit cycle. If you get more benign credit flows, it's easy for housing not to be such a drag on the overall picture.
Focusing in on Europe, I'm curious about where valuations suddenly make a weakening economy and a fiscally constrained region actually attractive. Where is that bar? Have we already crossed it?
I don't think so. You are currently at 13 times, 13.5 times. Your average valuations in terms of the 12-month forward P is 14 times. You're not obviously depressed in terms of valuations. If you look at the price level, you're close to all-time highs. Sometimes people are trying to make the case that there's some kind of depressed value that you want to pick up. With markets close to all-time highs, very hard to make that case. And the reason for this is that the European equity market has really decoupled from the domestic growth story. You had effectively a recession in Q4, you had a recession in the UK, didn't prevent cyclicals from versus defenses from rallying, didn't prevent the market from going to all-time highs because you're so levered into the global growth story and you've benefited benefited so much from the strong growth rebound in the US last year. And so I don't think anything is depressed here. The question rather is, I would turn it around and say, if we now see the slowdown in the labor market in the US, and of course we had a very interesting labor market report on Friday, I think you are vulnerable at these levels if that weakness in the US labor market is confirmed.
Vulnerable in the States or vulnerable in Europe?
European equities have tracked global risk premia, which are very tight because the US recovery has been so strong. So if the US recovery now falters, if the labor market rolls over, there will be a widening of global risk premia. And that makes European stocks at current levels very vulnerable.
Why is the DAX near record highs, given what's happening in Germany?
Because of exactly that phenomenon that I've just highlighted. You've decoupled... I mean,
but it's exposed to China.
It is exposed to China, but you have nonetheless caught the bid, effectively. So if you look at European equities, and the DAX effectively is a levered function of that, they track global risk premia very, very tightly. And I think if you're not aware of that angle, everything seems like a puzzle and a paradox.
Yeah, exactly.
But if you're aware that the main thing that drives European equities is the overall risk sentiment that is reflected in risk premia, such as the US high-yield credit spread, and you say, as long as credit spreads effectively are at rock-bottom levels, asset prices will be strong. But if you get anything happening with the US labor market recovery, the first thing that happens is risk premia go from the bottom end of the range to the top end of the range, and then you see the fallout in terms of asset prices more generally.
I actually just want to... I was going to ask you a question about the luxury sector, but in terms of the beta of Europe to the US data, therefore, what is it?
So I would say, rule of thumb, high-yield credit spread is at 300. The best it typically is 300.
Yeah.
So it's basically macro perfection priced into risk premium. If you get a hard landing, you go to 1,000 basis points.
Yeah.
From 300 to 1,000. Every 200 basis points increase takes 8% off global equities, but takes 12% off European equities. So you've got a beta of around 1.4.
So really high. So Europe is a high beta trade on US credit spreads.
Yeah. So Europe is, in a global context, the cyclical play. It's got a lot of cyclicals, therefore higher beta to risk premium. And it's also the value play. So if bond yields rise, that is typically good for Europe's relative performance.
Yeah, that's the bit that confuses me. Yeah.
No, it's because basically value stocks outperform on a relative basis. Yeah. So Europe is cyclical and it's value. So what it really likes is tight risk premia and rising bond yields. What it really hates is widening risk premia, falling bond yields. And that's the scenario that we see going forward.
That's interesting. And thinking about things we get from the United States, I wonder about the impact of the election stateside in Europe. And yesterday we were having a really interesting conversation with Bani Baweja, who was saying that, and it took me a moment to get my head around it, he was saying that looking at the profitability that's priced into stocks globally, stocks in the United States this was, but looking at the tariffs that maybe the Trump administration wants to price in, he thinks that there are various parts of the global equity space that are basically pricing in a Trump win, even if that's not what, predictive models say, or there's a lot more nuance to people's expectations. What do you think what are markets telling you is priced in terms of elections?
So I think when we had this high point of the Trump probability winning after the assassination attempt, betting markets had him at 70%, Europe was strongly underperforming for about a month, and basically Biden looked very weak in the debate and so on. And you saw that the market effectively decided if Trump comes to power, you first of all have to look after your own security for the first time since the Second World War. Plus, you're going to be hit by all these tariffs. So Europe was clearly identified as a victim of a potential Trump presidency. That has gotten priced out again. And for now, because there is, first of all, little clarity on who's going to win, and then secondly, some haziness about the policy platform. Right now, after that was reversed, this move that I've just described, very little is priced. Markets are holding their breath. They haven't really engaged with the election. And so, therefore, if you were now to get a Trump presidency, which is likely, I think there would be more underperformance coming for Europe because you would be effectively hit by this double whammy of basically more defense spending and more tariffs to deal with.
You say a lack of policy clarity. I would argue it's the same on the Harris side as well. What is the Harris trade?
I don't think there's a clear... I think you have seen some economic policies to the left of Biden, but I think to simplify, I would say this is the continuity candidate. There is not going to be... This is the status quo that you'll be getting, maybe with some tweaks. And I can tell you from all our client conversation, we had a big macro dinner, for instance, yesterday. The delta, i.e. the shift, is really if Trump comes in. If you get Harris, you get basically business as usual, just continuing.
Can I just wrap up the conversation with a quick comment on what's happening with the cyclicals? LVMH topped out this year at 872. It's now trading at 614. It's near its lows, 607. Does that trade continue? Or is it time to buy that trade? I just want to come back to the China angle.
Yeah.
That looks like a play on China.
Yeah.
If China's stabilising, do I buy LVMH? You've also got this line that you're worried about cyclicals continuing to decline.
Correct.
Which one of those applies best to LVMH?
In a way, I would say both. So we are more worried about the US labour market, as I've highlighted earlier, than about China. If the US labour market rolls over, and of course we're seeing a sharp slowdown now in hiring in the US, then cyclicals will underperform. But very importantly, we've got so much ambiguity and so much uncertainty where we're going. You want to have, even if you're defensively positioned, and of course that was a winning trade over the last couple of months, cyclicals have underperformed by 15%. You want to have some cyclical hedges. And these are the cyclicals that have already suffered a lot, that are already pricing a lot of negativity, and that would benefit if bond yields continue to decline. These are the quality and growth cyclicals that have underperformed. And for us, that's luxury and semi. So in a defensive portfolio, these are cyclical hedges that we like, where we're overweight because we think they've already priced a lot of the bad macro news.
Sebastian, nice to see you. Sebastian Raedler, Head of European Equity Strategy, joining us for Bank of America Global Research. Talking of LVMH, let's show you how that stock price is performing this morning. This is the core six around Europe. Firm focus on what is happening in the pharmaceutical space this morning. You can see Novo Nordisk is up very nicely. Roche is softer. We'll find out the details of that in just a moment. But LVMH rallying quite decently as well. But it's the semi-sector where we're seeing the real gains. Look at ASML, up very nicely this morning, up by 3.5%. Let's get some details as to what is happening with the single stock story. Here's Joe.
So there's a real focus on the large cap stocks today. As you mentioned there, Guy, in the Super 6 now, Roche and Novo. These two stocks are actually the biggest movers on the entire Stock 600 on a points basis. So Roche leading the declines following news that their keenly anticipated obesity drug causes higher rates of sickness and nausea than expected. And that is really hammering that stock this morning. That is the biggest decline at the moment since around January. So if it stays that way, it will be the biggest loss in around 8 months. There's the banks as well, though. Now, these are the three stocks that JP Morgan is flagging as potential takeover targets. Obviously, the news yesterday of UniCredit potentially looking at Commerzbank with that stake purchase. But they also do highlight ABN Amro and Banco BPM over in Italy. Bear in mind, we got that big stake sale today from the Dutch government as well. But those stocks gaining pretty impressive for Commerzbank, given it was up 17% yesterday, extending those gains once again. Then we'll look at some chip makers. Guy mentioned just a moment ago ASML, but the whole sector is higher now. This does appear just to be a bit of a read across from the US. The Philadelphia Semiconductor Index was up 4.9% in the US yesterday, and that is feeding through into BE Semi, Soitec, Aixtron and ASM as well. All of those getting a bit of a rebound. Doesn't really seem to be any news driving that, but really a read across from the US. Then just a couple of corporate updates to finish on, both in the UK. Renishaw, now this is an engineer whose machines are used to assemble iPhones, so they're an Apple supplier. Got a pretty strong sales update out of them. We're up 1.5%. New iPhone coming out will be helpful for them. But going the other way, Fevertree drinks. We're not drinking enough gin and tonic in the UK, according to Fevertree. They say the UK is the weakest market at the moment. The US still doing pretty well. They love a G&T over there. Fevertree down 6% in London this morning.
I'm sure we can do something about that. Help them out with the gin and tonics. Joe Easton from our Equities team, we thank you so much. Coming up on the program, we go right to where Joe started. Roche's disappointing study and why the latest findings on their obesity pill are causing concern for some investors. We're going to dive into the details next. This is Bloomberg.
Welcome back. You're watching the opening trade. We're nearly 90 minutes into the session, and as you can see, we see a lot of green on the screen. There are some exceptions to this, though. Roche shares are under a little bit of pressure this morning. This after a small study, and we're going to talk about the kind of where we are in this study process, has found that the company's closely watched experimental obesity pill has significant side effects. Nausea, vomiting, blood pressure issues. The results raise questions about whether this novel medicine can compete with the next generation, the current generation, of weight loss drugs. Sam Fazeli joins us around the table from Bloomberg Intelligence. We need a little bit of history here. So a few weeks ago, Roche shares, out of the blue, rockets. And the reason for this is we've got details of a phase 1 trial that seems to indicate positive things about this new obesity drug that they're talking about. Immediately after the show, I'm a little confused, and I come and find you. And you're like, what on earth are we doing? Why are we releasing phase 1 data? talk us through why we don't release phase 1 data.
I mean, biotech companies do, Guy.
Yep.
You know, that's because that's all they've got, right?
Yep.
You know, that's what they live on. They have one drug, two drugs, and they have to tell the investors what's going on with those drugs. Pharma companies tend not to. Obviously, there's no rule, there's no law against it, but they tend not to because they're early data. This is a 4-week data set. And this is a world where that balance of efficacy and side effect is very, very nuanced, and you have to just spend quite a lot of effort. And if you listen to Novo and Lilly, etc., on their calls afterwards during the second quarter releases, they did say that. You can't just take patient numbers of this size, small trial, and say, oh, I've got this efficacy. What do you pay? You pay the side effect profile cost. So
that's what we're seeing now.
That's what we're seeing now. The drug is good efficacy, but they need to work it out still. They need to get that balance right. And that's why you don't really push too hard on phase 1. And I'm not saying they did push too hard, but I wouldn't have released that.
Right. And so this is what we're still learning about this class of drugs, is it, Sam? You know, what is the end product going to look like? You know, we've got injectables from a couple of places already. And here we've got a pill that seems to be, as you say, effective, but has side effects. There are other things in the mix here when you're looking for the right, you know, way to treat this. The effect's got to be durable and it's got to come at a low cost. And that's why people were looking at pills, I think, wasn't it? Because it was going to be cheaper and therefore more opportunity globally.
Yeah, as you know, there's a supply issue. So, demand is constantly outstripping supply. So if you have a small molecule drug that you can manufacture as a pill in little blisters, as we're all used to seeing, it logically should be easier. Now, manufacturing processes aren't always that easy. But so this would be a great thing to have. There are other companies trying to develop oral too. And it's also possible that you have to think about, do people want to keep injecting themselves ad infinitum? Because that's probably what we have to keep doing, taking these drugs. Switch to an oral, that's good. But they have an opportunity here to work it out. Roche is definitely not out of the picture. It just was way too early.
Yeah. But now so much of the concentration is on side effects, as you point out. But is there a bar that they have to meet in terms of eliminating some of that, competing with the likes of Novo Nordisk? And in the obesity space, is that what it's coming down to, or is there something else?
Yeah, so that's one of the things. You need to balance that side effect and efficacy. Obviously, if you give less drug to reduce the side effect, you'll get less efficacy. It's just a normal world of drugs.
Yeah.
And the other thing that people are very focused on, and apparently my colleague Michael Shah is at the conference where this data is presented, he said there's quite a buzz around this molecule that's related called amylin. And there are companies, Zealand Pharmaceuticals, I think we had the CEO interviewed recently, Lilly, Novo Nordisk, they've all got this kind of molecule too. It's all in the same area, same hormonal pathways. And that's the buzz because it gives you weight loss, comparable potentially, but less side effects. And it seems to reduce the impact on muscle loss, which you might see with these current drugs, with the current mechanisms. So that's where there's a little bit of buzz.
Just come back to the share price. We'll get the team to put the one-year share price up again. We've basically almost round-tripped in terms of the initial burst of enthusiasm we saw when this phase 1 trial was first published. We are now pretty much unwinding that move. Where should we put Roche in terms of the universe of those developing weight loss drugs? How should we think about how Roche plugs into that? Are we back to where we started? Is that the correct way of thinking about it from a market point of view? Is it more competitive going forward because of the fact that it's got a pill? How should we think about Roche in terms of the competitive landscape?
Right, perfect question, because there's a whole host of other data sets from competitors or incumbents that are coming out in the next few 6 to 12 months. From oral pills to new drugs such as the combination of amylin and the current mechanism of action GLP-1, cagrilintide from Novo Nordisk. That's shown some really interesting efficacy that suggests that the combined product is more than the sum of the two. Right. In terms of weight loss. So there's lots of that data coming out. You just have to put Roche where into the future compendium of drugs that will be out there for obesity as one of the potential players. No one's really going to be in a position yet to decide who is the winner. And maybe you don't need the winner because it's such a massive market.
Sam, thank you very much. Sam Fazeli from Bloomberg Intelligence with the latest on Roche and its part of that obesity drug market. Let's stay with the pharmaceutical sector. Bavarian Nordic shares are higher this morning after a study found a single smallpox vaccine dose is 58% effective in preventing Mpox infection. Let's get more from our colleague Janice Q, who's been following this story. Janice, good morning to you. So what does this study show then? Why is it important?
8% might not sound like a lot to everyone, but this is pretty effective. And the scientists who did the study have said that it really does show that the shot should be made available to communities that are at risk. The study was done in 2022 in Canada when there was a less virulent strain circulating globally. And, with the more virulent strain and this outbreak that we're seeing in the Congo, vaccines have been a huge sticking point and a big talking point. And so this really just bolsters the move by health officials to get vaccines on the ground and get those shots into arms.
And the Bavarian Nordic CEO has said that a single shot has about 80% effectiveness, whereas these results are lower than that. Why the discrepancy there?
So rates of vaccination effectiveness do vary, but no trial has been done on this vaccine that is a randomized control trial, which is effectively the gold standard for clinical trials. And so in the absence of that randomized control trial, this is probably the closest thing. This trial matched to an unvaccinated population, and so they could see the difference quite clearly. And that could be why there's been this discrepancy between what the CEO has said and what this trial shows.
All right, Bloomberg's Janice Q joining us from Johannesburg this morning to break down some of that data. We thank you so much. Coming up on the program, we go right back to the macro. The ECB widely expected to lower borrowing costs today. Interest rates, the bond market, very much in focus on both sides of the Atlantic. Luckily for us, we've got Jennifer Barker from BNY Mellon. She's going to be joining us around the table in just a few minutes. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade, 30 minutes into today's session in Europe, and we see some strength coming through. You can see in particular on the Xetra DAX. If we look at the sector breakdown, the technology sector is the best performer today, really picking up where the Nasdaq left off, I guess. The Nasdaq up by more than 2% in the session stateside yesterday, and that's perhaps setting the stage for these gains we see this morning. US futures then, Kriti, are up by 0.3% on E-minis and Nasdaq.
Yeah, the green on the screen on both sides of the Atlantic is really fascinating here because it's coming off of course, the CPI data in the States. Perhaps the argument here is simply that there's a little bit more clarity. It, of course, comes ahead of the ECB decision today as well, where, again, we are expecting another cut from the bank. This is important to keep in mind because now that we're looking at a global easing cycle, how does this show up in the banks? How does this show up in bonds? We have the perfect guest to join us here this morning. Joining us now around the table, Jennifer Barker, Global Head of Treasury Services and Depository Receipts over at BNY Mellon. We thank you so much for joining the program. Look, we're talking a lot about this interest rate story and kind of this market plumbing story around the world. And I guess what I'd like to kind of get your insight on is how is it showing up post-COVID, post-pandemic, when we're seeing these interest rate changes happen far more quickly than they ever have before? From your vantage point, how does that show up?
Yeah, so we see it show up first of all, thank you for having me. So it's great to be here. So we see it show up in a couple of different ways. With the higher interest rates, we see clients demanding a couple of different things. First is they need better data and analytics to really understand how best to optimize their cash and how best to optimize where their money is at the right time. And the second is settlement cycles. And so it's not just payments, which is my area of expertise running Treasury Services for BNY, not just the payment settlement cycles that have shortened, but also, other types of securities, T+1 that was launched earlier this year. So it's really helping them optimize that cycle, and it's really helping them understand where is their money around the globe to be able to settle those transactions exactly when they need it.
Well, let's expect. You said settlements. My ears immediately perked up because it's something we've covered on the show quite substantially, and that Europe has a little bit of kind of catching up to do when it comes to that clearing, et cetera. And yet, you also mentioned payments on the digital banking side as well. It almost feels like Europe is ahead of the States from a digital banking perspective. And I'm curious where, for a European audience, the work needs to be done, and if it's even being done.
Yeah, so I would say on the digitization front, you're right. Europe and Asia is ahead of the U.S. in the context of launching an instant payment system. But there are very common trends that we see around the world in terms of digitization. All of the market players are moving they want to be 24/7, they want to access real-time data, and they want to digitize everything from end to end in terms of payment flows. And particularly in Europe, we see a lot of the banks want to invest in infrastructure. About 92% of the market players want to invest in more infrastructure. They want to send more cross-border payments. And two big themes we see are they want to do all these things, but it is expensive to be able to do these things around the globe, and to be able to connect the myriad of payment systems to be able to do that is often cost prohibitive. And so they need help bringing all that together into a central, cohesive client experience. And so that's a common theme, particularly we see in Europe.
And so they're trying to do a lot. They're trying to change a lot. They're investing a lot, and things are moving more quickly than they were, Jennifer. And so I'm wondering what tools they turn to get that done. I mean, does AI play a role here in what these clients are doing day to day, what their employees have to do, and what they can leave to the machines?
Yeah, so a couple answers to that question. So first of all, they are turning to AI to help them do that. So AI can do a number of things. It can help their employees be more efficient. It can help their client-facing teams be more efficient so they can spend more time with their clients. It can help in their operations be more efficient. It can also help them, analytically understand and, optimize their clients' flows. But they also turn to providers like BNY because we are globally connected around the world. We build out all of the technology infrastructure so that our clients don't have to. We maintain it. We maintain all of the upgrades. And we bring all of that together through a single technology upgrade so that they can really focus on their clients and their strategy.
When you think about that AI journey, and this is a preoccupation for the markets as a whole, but each industry has its own experience. When you think about that AI journey, I mean, how much of that is already done? When you talk to clients, do they say, we have so much more we can do on this front, we can make this process 80% more effective? Or do they say, we've kind of done what we can? Where is the conversation?
I would say we are earlier in the journey, absolutely. I would say AI is a topic that people are starting to understand, and they're starting to develop the use cases around, and they see the application, particularly in the payment space, that I work on. But in terms of, launching that at scale, I would say we're in the early innings of that.
In terms of what's going to happen next, is scale going to be important? If you are a bank, we're spending our morning talking about banking consolidation in Europe, what's going to happen with UniCredit and Commerzbank and various other permutations around Europe. Does Europe need to have bigger banks in order to invest in a process that is unfolding rapidly? Does scale matter at this point?
Scale matters in banking for a variety of reasons, right? Because obviously from a regulatory perspective, because from all the technology upgrades, you have payment standards such as ISO 22 coming out. And then you have, cyber and other resiliency. So scale is important because you have to keep pace with not only local payment upgrades, but all around the world because, most banks service clients, not just in their home market, but in other markets as well. So scale is very important. But the good news is that banking providers don't have to do it all themselves, which is where partners like BNY come in to help them do that.
And in terms of the patchwork that is Europe, when you think about payments across Europe, is it easy? Is it difficult? How does it work? We talk about the need for a banking union. What does that look like? From a payments point of view, how much of a banking union do we already have?
Well, there are a variety of different ways to connect payments across Europe. And so I think really the problem that we're trying to solve is how do you make the technology interoperable? There will always be new ways to pay, right? And so there's the SWIFT system, there's the multiple payment systems you're referencing, there's the multiple instant payment systems, not only here in Europe, but around the world. And so ultimately, you talk about scale and technology, they have to be able to work together in a cost-effective manner to solve client needs. New payment systems will pop up, and we have to be able to do that.
So, Jennifer, I think, and for our global audience, I think this is important to highlight that you represent BNY Mellon, which handles most of the clearing around transactions that come through and are approved through the New York Fed. And the reason I put this into context for our global audience is because you have a unique vantage point in terms of seeing the liquidity and seeing the positioning for banks around the world, corporations around the world. And I'm curious what, from the clients you're speaking to, what the liquidity concerns or perhaps lack of concern looks like, especially ahead of the U.S. election. We're talking a lot about the markets being cautious at the moment, given a lot can change going into the end of the year. Does that show up in the liquidity picture?
So you're absolutely right. We clear about $3 trillion worth of U.S. dollars every day. So we do clear a lot of payments. We don't see that as much because ultimately what clients want to be able to do is optimize their flows, and particularly around dollars. As you look at rates and potentially rates coming down, clients continue to position themselves to really make sure they've optimized their liquidity both within their companies and then across their entities across the world. And so whether they can access dollars locally or they have to access across borders, really optimizing dollars is really, really key to make sure they're earning interest on every single dollar that they have in turn.
So, and this is a comment that we're hearing from so many banks around the world and so many of our guests on the show is that liquidity concerns aren't showing up right now the way that maybe they have in the past. And part of that is going to be post-COVID, extra money sloshing in the system. But I'm also curious about what that red flag might look like. What do we need to see to say, ooh, that makes me a little nervous?
Yeah, I think this is where, to your question on AI, this is where AI really helps us understand, looking at client flows and looking where clients are, where things are a little bit out of the ordinary. So as those things help us understand that, that's when we would work with our clients to really help them develop alternative strategies.
All right, Jennifer Barker, we'll leave the conversation there. We thank you so much for coming and visiting from the States, Global Head of Treasury Services and Depository Receipts over at BNY. In the meantime, Guy, we have some headlines crossing in the auto space.
Yeah, more headlines coming out of the German auto space that we need to pay attention to. It'll be relevant as well to what the ECB is thinking about today. VW and its unions, I'm imagining this is IG Metall, but don't quote me on that. To start, it is. There you go, Anna, telling me you can quote me on this. To start wage negotiations on September the 25th. This is we see VW taking off the table some of the job guarantees that have existed for generations in this space.
Yes, and it's interesting. So they're bringing forward. They were due to go to talks with IG Metall in October, and they're bringing those forward because of everything that has happened, because of their plans, because of the stories we've been covering about the risks to some of their production facilities in Germany.
Yep, this is the EV transition works less well, and the strains of China and the impact on Europe continue. There's did you see the story this morning about the Chinese saying, don't build in places like Europe, key technology.
Exactly. So assemble some of this key technology in China and then send it to Europe already assembled was the...
I'm not sure that's going to work on the tariff front.
The instruction. No, exactly. Tariffs get quite picky about all of that detail. Let us talk about what is coming up later in programming in the next hour. We'll be speaking exclusively. Francine Lacroix will be speaking to UniCredit's Andrea Orchel about his plans for Commerzbank. What exactly does he intend? Our reporting suggests that he does want to take over the whole business. Let's hear from him, shall we? That conversation coming up in the 9 o'clock UK hour. Up next, we'll discuss the potential for that deal to go ahead then. This is Bloomberg.
Hi, Lizzie. I mean, whatever happened, it isn't Curler.
Hello.
No.
Hello, how are you?
Working.
We're all right. It's Thursday. It's not going to rain today, apparently. We'll see.
Yeah.
It's painting garden furniture and got soaked yesterday. Very annoying. Is it?
Painting garden furniture?
Oh.
Yeah, I'll put some of it away. Some of it needs sorting out.
It's the DIY.
Not really.
It's so funny to hear guys like
I feel like Guy would never pay the man to do anything.
No, but my wife kind of sneaks things in without me knowing.
Oh, what is the story?
Goldman revises ECB. Faster pace of cuts. Oh, right. Have you seen this?
Yes. Also, where's the BN for it so we can see the numbers?
Welcome back. 43 minutes into the equity market session. We are bid pretty much across the board. This is a reaction to yesterday's session where we saw the States afternoon basically delivering quite significant upside on the markets there. That needed to be priced in this morning, and that's basically what we are doing right now. Moving forward, we are now going to focus on what is happening with the ECB. It is going to be the central story, I think, in the afternoon. We're widely expecting a 25 basis point depot rate cut today. That will take us to 3.5%, a prelude, some would argue, maybe for what we're going to see out of the Fed. A headline crossing within the last few minutes. I can't actually see the research in my inbox, but we'll get to that in just a moment. The Goldman Sachs revising its ECB and Bank of England forecast. It now sees a faster rate of cuts from both of those two European central banks. Let's go to Frankfurt now. Lizzie Burden is standing by inside now the ECB. She's standing by the big euro sign, which I always love. Takes me back to my days of standing outside the ECB in a different location. Lizzie, walk us through the meeting today. What are we going to be expecting? We've got Goldman Sachs now upping its estimates for what we are going to see after this meeting. What are we going to hear from Christine Lagarde?
Exactly. I wouldn't expect Goldman to be upping its forecast for today. No one sees a jumbo cut from the ECB today. But the reason that a quarter point cut is on the table is because you've got inflation risks receding and concerns mounting about the growth outlook. So it's unanimously expected by economists, fully priced by markets, and it puts the focus on the October meeting. And this will be the focus, I think, of the questions at the press conference. This is where the divergence lies between markets and economists. Can they squeeze in another cut before the end of the year, or do they stick to the quarterly cadence of quarter point cuts all the way to the middle of 2025? In any case, I would expect Christine Lagarde to be pretty coy here, sticking to the data dependence language, not pre-committing to a particular rate path, not just because of the data, but also because of the divergence on the Governing Council over where the neutral rate lies. But if she does pour cold water on an October cut, you could see a bit of a euro bounce.
And just so we don't get confused, Lizzie, there are a number of rates that sometimes move on these days. And today there is some expectation that we see the refinancing and the marginal lending rates moving, and perhaps by 60 basis points. But that's going to be a sort of sidebar story, isn't it? Tell us what we need to know about that.
Exactly. It's a bit of a red herring, this. Don't get excited about a 60 basis point cut. It's not expected to immediately move markets or impact the economy. It's more about the plumbing. So it's kind of a hangover from the era of negative rates. They couldn't cut these two other rates deeply into sub-zero territory. And back in March, you had this decision on the operational framework to shrink the spread between the three of them. And today we will see that happening. But really, it's more about oiling the wheels behind the scenes as the ECB shrinks its balance sheet.
Lizzie, walk us through kind of the key players here. Are we seeing consensus when it comes to that governing council, or are we seeing a little bit of pushback?
So you are seeing more of a consensus when it comes to today's meeting in terms of cutting by a quarter point. But as you look ahead, this is where you get the divergence. There is a range of views as to where the neutral rate lies. Could it be at 3% or down to 2%? And you've even had policymakers saying that as we get towards that neutral rate, policymaking is going to get more difficult. Not that it's easy in the near term, but the reason that you have this disparity of views is because of the risks to the inflation outlook versus the risks to growth. And it'll be interesting as well at the press conference to see what Christine Lagarde emphasises and whether the reaction function is shifting towards growth. Again, you could see that encouraging the dovishness of traders, and you can see that already in that updated Goldman forecast.
Lizzie, great stuff. Thank you very much indeed. Lizzie Burden joining us from inside the ECB. We will bring you that press conference a little bit later on. Some great coverage coming up from our team surrounding Christine Lagarde, the decision and the press conference. I wonder if she'll be asked about cross-border banking consolidation within that press conference. It's certainly a subject that we've spent a lot of time over the last few hours talking about and thinking about. UniCredit, Commerzbank. We've got lots of questions. Let's try and get some answers. We're not going to get the answers just yet, but I have to say, we're joined around the table now by Tom Metcalfe and Francine Lacroix. Francine is very soon going to be talking to Mr. Orchel.
I'm excited.
I'm excited. I am really excited.
I think we should take a bet, actually, on how many times Christine Lagarde gets asked about cross-border consolidation. I'd say 6 times.
Okay, I will. I think that's quite a punchy bet, but I'll take the other side of it and maybe suggest that she goes a little less than that. But I think I am fascinated by it this morning because I want to know, what's the key question for Orchel this morning? What do you ask him?
So the key question, I think, Tom and I probably agree on this, is whether he wants a full takeover. So this is how he's done it, right? He had a 4.5% stake in Commerzbank. And then yesterday there was this news that he took 5% from the German government. What's his intention? So at the moment, what I'm hearing from the UniCredit camp is that this is an option. So they haven't gone, nuclear, we want to take over, we have the money, we'll do anything it takes to have it. But it's a good fit. We've had many interviews with Andrea Orchel where he says he wants to be the European bank or the bank for Europeans. We know that he has cash. We know that he wants bigger. We know that he wants cross-border. He's a deal maker. So it's almost a given, but we haven't heard it from him. So let's see what he says.
Yeah, he's a deal maker, and he's long believed that Europe needs bigger banks, hasn't he, Fran? He said that many times. If the European banking scene is going to, go toe-to-toe with the American giants and Chinese financial services, then it needs to have bigger banks, combined banks. So we know that's broadly his intention, isn't it?
Yeah, and we know, look, he wants to compete, and when he competes, he wants to win. So it's true, he always has, I think, on the back of the mind that he wants to beat Wall Street. It's interesting that actually this happens in the week where Draghi also talked about a banking union. Whereas that, every time you speak to Orchel, he brings it up, saying we need to be better, Europe is falling behind, we need to compete and go stronger. But I'm not sure the noises from Germany are very supportive of that.
If Lagarde is asked lots of times about banking M&A, maybe she can just refer all the questions to Mario Draghi. So I'm sure my predecessor will love to take those questions. Kriti.
Tom, let's dive in on that. How believable is this now? Does this create some sort of more credibility to the idea of a banking union or cross-border consolidation now that Orchel is suspected to make this move?
Yeah, I think any time there's stuff like this in the ether, it moves things forward. And it really will be fascinating to hear what Andrea Orchel says to Francine in terms of, what is his posture, what is his sort of, official line on this. And, selfishly as well, I'd just love to hear, the mechanics of this. He's a legendary deal maker, so does he go out and does he actually need sort of external advice? Does UniCredit need sort of, the classic banking lineup you normally see?
Because he's done lots of deals before, hasn't he?
He's done every deal.
He did. So Upo Vereinsbank, he advised on that. Anna was pointing out earlier on as well.
Well, courtesy of Tom's team.
Well, OK, fair enough, but I'll give you the credit. He did, it was ABN Amro.
And RBS.
What was now NatWest. So he knows how this works.
He does. So the concern, and
but
maybe we'll put that to him.
Good.
Not all of them were good. There's a lot of pushback in Germany on Hypo Vereinsbank and the fact that actually UniCredit, this was over 20 years ago, bought it and then dismantled it.
Yeah.
I think maybe he'll want a chance to say, well, look at the share. Now it's not doing too badly. But then it's a bit like being a doctor. I mean, if you're a great doctor, but you have to treat your own children, they say, please stay away, move away from the patient. So I don't know whether, Orchel has, I think, this idea of he wants something big because he thinks it's the right thing. I don't know whether doing it himself, not as an advisor, will make him do the right decisions.
It's interesting thinking about this as an option, Tom, because as we were discussing in the last hour, you wonder where the other big names in European banking are right now, what they're doing this morning. They'll be tuning into your interview, no doubt, at 9:30 UK time, to listen to Orchel and what his intentions are for Commerzbank, because there could be others. There could be other banking names around Europe that think, hang on a second, if we're going to do this cross-border M&A thing, and if we're going to do it for real, we want to play a part.
Yeah, exactly. It's a momentum thing, there's an atmosphere thing. So, guarantee all the boardrooms will be watching this scenario very, very closely, whether they're interested in doing anything or not. And I think even people who are saying publicly now, oh, no, we're very focused on organic growth, for example, if this does go through or, there's some kind of movement here, that sort of changes the landscape somewhat, and it might get people thinking differently. And, that's the biggest thing. Yes, huge hurdles, regulatory, political, but if there's a real appetite, deals can get done.
If they wanted to, they would, I feel like is the message here. There's a quote hitting the inboxes here from JP Morgan saying that this could potentially kickstart a European M&A cycle. And Tom, I'm curious how much of this is a longer-term play from Orchel, or how much of this is really just good timing from a crunch in the German budget, a little bit of opening up in the capital markets. Is this just really lucky with timing?
Yeah, no, I think from UniCredit's perspective, they were always looking at this for years. It was always been, one of these sort of perennial rumours. And look, things just lined up perfectly. The German government put out these shares in such a way that UniCredit could see a way of buying big. And we understand that, it was that sort of the government almost tipping their hand that prompted Orchel to buy, quietly in the market, sort of an equivalent stake, about 4.5%.
But there are other stakes around Europe, aren't they, that he could potentially be looking at as well? If it's not this deal, is it another deal?
I mean, it could be, but we've heard it from Intesa. We've heard it also from some of the French banks. I mean, a lot of these banks are sitting on cash that wants to be used for possible M&A. I think a lot will depend on how the trade unions actually behave. And if I know anything about Andrea Orchel, is that he doesn't want to lose money on this deal. So suddenly, if it gets blocked for like 9 months because it depends on job losses, on what he has to keep or not, and we sometimes underestimate. Germany is very unionized. Germany will be organized. So it'll be, I think, crucial also to understand from him if he got the blessing from the German government ahead of this.
Well, the shares popped a bit yesterday, didn't they? So maybe he was pleased with that. Tom Metcalf, thank you very much. And Francine Lacroix, of course. She'll be back with The Pulse. Catch Francine's exclusive interview with the UniCredit CEO, Andrea Orchel. That is at 9:30 a.m. UK time, so that's coming up in just over half an hour's time. A quick delve into some of the other items on our trading agenda this trading day. We've got an IEA oil report coming at 9, so that's in around 5 minutes' time. And given the pressure we've seen on oil prices, until the last couple of days, that is, where we perhaps have more focused on hurricanes,
Hurricane Francine.
Yes, I was just thinking that,
How convenient.
There's more than one, I promise you.
So that's in focus. We've also got an ECB meeting. We've talked a lot about that, of course, and what the expectations are. We are expecting to see a second cut in this cycle from the ECB. We get some jobs data, but it's the initial jobless variety. Claims data later on, and a few earnings coming through as well.
Yeah, Kroger, Adobe, looking forward to that one. It is the ECB. We're going to be focusing on that a little bit later on. What are we going to see in terms of guidance, I think, is going to be critical from here. I think it's interesting that Goldman Sachs has also upgraded its estimates for what the Bank of England is going to be doing.
And we'll get the detail on that because the market is moving in that direction anyway, isn't it? Thinking about more cuts from the BOE. We saw that price in further cuts yesterday.
Well, that'll be good news for Rachel Reeves, but the latest data in terms of the GDP numbers coming out of the UK certainly signals that we're seeing a flatlining of growth at the moment. So maybe the Bank of England does need to accelerate.
Although Bloomberg Economics casting that as just removing that risk of overheating in the UK economy. So
overheating?
Yeah.
That's what it feels like.
Ironic.
With the labour market as tight as it is, or the risk of going back into a sort of inflationary period, more inflationary period.
Absolutely. We should just point out that as we're speaking more about the UK, we are actually getting a little bit of the bank read through when we're talking about those capital requirements. It's where we kicked off the show. It's kind of where I think we should end the show as well, is that it looks like a less than expected move in terms of that 1% increase in capital requirements. The expectation was about 3%. They're competing with the states and the EU on something like 9%. It's a pretty broad rally. Some of that's a catch-up to what's happening or what happened in the last 24 hours in the States. But the banks are outperforming right next to the likes of ASML, SAP, etc.
The big bank bosses are going to Downing Street today. They're there primarily, as we heard earlier, to talk about what is happening with the Basel story, but I suspect they'll also be lobbying heavily against tax rises that we're anticipating from the Treasury in the next budget. So that wraps the show up, but make sure you stay tuned to Bloomberg. The opening trade may be over, but the Pulse is next. Francine has an interview with Andrea Orchel. Looking forward to that conversation. The highlight of the morning. This is Bloomberg.